If you're keeping money in your savings account and not investing, you are actually losing money in the long term. Do not worry though, if you are new to investing and don't know where to start from, I'll be sharing 3 simple step plan ideas on how to start investing. And by the end of this video, you will become a pro. You will know how to start investing, where to start investing, and how to remain consistent. So before we dive into steps, let's talk about why investing is so important. Did you know that if you left money in your savings account, with the current rate of inflation, let's say inflation is 4%, and your savings is giving you just 1% return on investment, your money is actually losing purchasing power by about 3%. And in order to mitigate that, we need to start investing. So on average, the stock market has seen to return on average return on investment of about 7 to 10% and even more on average annually. So imagine your savings account is just returning 1%, inflation is 4%. So like I said, you're already 3% in the red from your money. But if you're investing, getting a 12-13% return on investment and inflation is 4%, you're having a profit of already 9% as it stands. So can you see why investing is very important? Investing is also very important because it is a key way to build wealth for the future. We keep saying that no one ever became a millionaire by salary earning. No one became a millionaire by saving, but you can become a millionaire by investing. Also, another thing to note when it comes to investing is time is your greatest asset. You will find something called compound interest growth. You will see that the longer you leave something in the market over a period of time, the bigger and the higher your return on investment will be over a period of time. So you see there are some examples where we start investing like for 5 years, for 10 years, and for 30 years. You will notice that when you invest longer, your money works even harder, and your principal or your principal that you keep investing, or your capital you keep investing over a period of time, your interest surpasses that, and that is what is called compound growth. So compound interest is interest on your capital, interest on the interest, and interest on the interest, and it keeps getting bigger and bigger. Imagine a snowball. So imagine a snowball going down the hill, and it's catching up more snow as it goes, and by the time it gets down the hill, it's a very big snowball. That is similar to compound interest growth. The longer you leave your investment in the market, the bigger the return is in the end. All right, now let's discuss the 3 simple steps to start investing as a beginner investor. The first thing to do is to choose your investment platform. Choose your brokerage account. Here in the UK, we are entitled to invest and save up to £20,000 in the financial year through an instrument called the Stocks and Shares ISA. So the first thing I will do is to choose my brokerage account. An example of a brokerage account is Trading 212. Another example is Vanguard UK. Please note that this is not financial advice, but this is all just for educational purposes and recommendation. So the Vanguard UK is great for long-term index fund investing. Trading 212 is great for stocks and ETF investing, and is also good for as fractional shares. So basically you can buy fractional shares on Trading 212. Once you've chosen your platform, please now set up your account. This should take nothing less than maybe about 10 to 15 minutes. But if you're in the UK, do not forget to use the Stocks and Share ISA account to enjoy tax-free investment, tax-free return on our investment. So any profit you make, any dividends you get paid, you do not pay tax within that 20,000 allocation that we've been given by the government. So now that your account has been set up, step 2 is actually thinking of what to invest. So I would recommend as beginner investors to invest in something or an instrument like index funds or ETF. A good example of one is the S&P 500. These are the 500 top performing US companies in America, and this is traded on the New York Stock Exchange. This S&P 500 index or indices is low cost, is diversified, and has proven that over a long period of time gives a good return on investment, usually about 10% on average. So another thing you can potentially invest in as beginner investors is something called REITs, Real Estate Investment Trust. These real estate investment trusts are high income producing properties. They give us exposure to the real estate market without having to manage properties, without having to get a mortgage, without having to deal with tenants. And these real estate investment trusts have been mandated by the government to pay us shareholders 90% of their taxable income. Means that they're able to give us more money back in return in something called dividends. These dividends are paid to us monthly, quarterly, or every 6 months. So this is an opportunity to get passive income. What is passive income? Passive income is income you get without actively transferring time for money, but you get it like when you're sleeping and just being invested in a stock or being invested in a company. The final step is to think about consistency. Investing is not a one-time thing, and investing is not a get-rich-quick scheme. It is to think about it long-term. So I would like you to set up automatic payments or direct debits to do this every single month. We have seen over a period of time that the longer you leave your investments going, the bigger your returns will be in the future. So whether it is investing £50 a month or £500 a month, we have seen that over a very long period of time, you will get more in return. Take advantage of dollar cost averaging. So whatever the market is doing, whenever it dips or it goes up, whether it's in a bear market or a bull phase, you just keep investing, keep doing what you're doing over a period of time for a long term. So in your mind, psychologically, think long term. Why are you investing? I personally am investing for my retirement. I'm investing for my future. What are your investment goals? And that will determine how you see your investing when the market or when the going gets tough. An example of the kind of returns you can get. So if you invest just £100 over a 20-year period in the S&P 500 that gives like a 10% return on investment, you would see that after 20 years, your value of your investment is £69,000, even though you only invested 24,000. So where did the extras come from? It comes from something called compound interest, and we'll cover that in a different video. If you found this video helpful, I would appreciate it if you hit the like button, subscribe, and in the comment section say, "Nancy, I am starting today." Thank you all for joining, and we'll see you in the next video so we can keep building wealth and keep getting richer together as a family.